Hello everyone, and welcome once again to our latest SB Talks podcast. Today is Thursday, November 17th, and I am lucky enough to be joined today by former RBA Governor and Stanford Brown Investment Committee member Ian Macfarlane. Today we'll be talking about where we're up to in terms of the inflation outlook, what does that mean for interest rates, as well as the broader economic state of the nation. Welcome, Ian.
Thank you.
Now, Ian, it's been almost exactly 6 months since we last sat down and recorded a podcast. And at that stage, it was just after the first RBA rate hike, a little gentle 25 basis point rise that time, pre-election. And as we recorded, there was a fair degree of unknown about where inflation was going to begin to peak out at, and there was a lot of peering into the future with concern. 6 months on, what's your reflections in terms of where we now sit? How is the picture? Has it become clearer for you?
I think it has, but we're in a strange position of the markets are almost in suspended animation. People think something, are expecting something bad to happen, but it hasn't happened. In fact, the real economy is still in very good shape, particularly the labour market. There's plenty of jobs, plenty of vacancies, unemployment rate at a 50-year low. It seems strange considering the people's expectations are still gloomy. The best example of this is the survey of consumer confidence.
Yes. Yeah.
It's a good survey. It's been going for a long time. And the current reading is extremely low. It's as low as it was in the GFC and as low as it was in March 20 when COVID first erupted.
So it's like we've got a disconnect between...
Yeah, but at the same time, consumption or retail spending is still going okay.
Is that the people still have a bit of their COVID savings to
well,
burn
I think
through?
so. They must, and their income's also grown
True.
quite well, so there's not a problem there. The one area where there is evidence of a bit of a pullback, of course, is in asset prices. Share prices are down, house prices are down, but not by much. But of course, everyone is expecting both of them to go down further. So that's where we are. And it is a strange position. So you're sitting waiting for something big to happen, and it hasn't happened.
And do you think part of that is because of we've had such a incredible increase in interest rates in such a short period of time?
Well, I think that when I look at it, I think...
the real economy hasn't even had a chance to catch up.
Yeah, that's true. But I think I'm comforted in some sense by the fact that in most countries, including here, we have been able to achieve a significant increase in interest rates, and it's been well accepted by the community. So in Australia, for example, the Reserve Bank's cash rate's gone up by 300 basis points from 0.1. Well, it hasn't quite yet, but I'm assuming
just under. Yep.
I'm assuming it will in December go another 25. So it'll have gone from 0.1 to 3.1. And people, as I said, people have sort of accepted this reasonably calmly.
Had you been sitting in your former role and contemplating doing a 3% rise in such a time frame, what would have been your fears around what could have played out in terms of the financial
I would have
system?
thought there would have been a much bigger community pushback than there has been.
And how would that have been? How would that have manifested itself?
Lobby groups, businesses, unions, politicians telling you don't know what you're doing. That's how it would have panned out. But of course, one of the reasons they've been able to do it is because, as I said before, the real economy has held up so well, and that's made it possible. But, and this is a subject I'll return to later, I think the public also look upon it as a return to normality. And it's not as though you're doing, the press sometimes use this word, aggressive, aggressive.
Everything's aggressive.
Interest is everything's aggressive and everything's a crisis. But I think the public looks at it that way. I think the public look at it as though we're returning to normality. And normality is not a frightening prospect.
Well, albeit perhaps the rate rises are still being digested, or being digested by, let's call it Main Street, or particularly those with the more recent larger mortgages.
We'll get onto that later. Yeah.
You do sound, dare I say, possibly slightly more optimistic. I think the last time, because the range of possible outcomes was so broad, you took us through that full range.
Yeah.
You probably hit a slightly more optimistic note.
Yeah, in the sense, what I'm saying is that the first stage of this necessary adjustment has certainly been achieved more smoothly than I thought.
Than you thought could be possible.
Yeah. So that's comforting. But of course, we haven't got to the full adjustment yet. And the full adjustment will depend very much on what's happening to inflation. And I think there is some good news there. There's more good news than people recognise, particularly if we look at the US, which is, as always, the most important market to look at.
Still sets the tone for global confidence.
Well, in my view, the US, we started getting good news on US inflation 4 months ago, and but people didn't recognise it because of what I think is a rather irritating convention, and that is the convention of expressing inflation as a 12-month ended growth rate.
Yeah.
And almost exclusively as that. So they take September this year over September last year, or October this year over October last year. Now, that is a very primitive and backward-looking way.
Because it obviously doesn't move in a straight line over the course of that full 12 months.
It just tells you what happened on average over 12 months. But you need to know more than that. What you want to know is, well, what happened last month? Or what happened last quarter?
Over the quarter.
Or if you look over a 12-month period, was the second half of that 12-month period lower inflation than the first half? So you need to do those sort of things. And if you do those things, particularly if you look at the actual monthly increase in US inflation, over the last 4 months, it's been, in July it was 0, in August it was 0.1, September it was 0.4, in October it was 0.4. You add those up together and annualise it, and what it's saying is that over the last third of the year, the CPI has grown at 3%.
Yeah. Dramatically better than the annualised figure that we're talking about.
And it's because some of those transitory elements have either fallen out or they've stabilised.
So do you mind just unpacking that a little bit further? Because I think transitory would have still been the hot discussion item 12 months ago, when central banks were still optimistic that a lot the inflation was entirely transitory and was going to work its way out of the system without needing to do what we've now had to done. Early this year, that became clear that it wasn't the case. So what is easing?
Well, I think it was always unbelievably optimistic to think all of it was transitory. But some of it was, and some of it has fallen away. But it's worth looking at not just headline inflation, CPI, looking at core inflation. In the US, this the most common way of doing that is look at CPI minus food and energy, and that's running about 6%.
Yeah.
It didn't go up as much as the headline inflation. It hasn't come down as much, but it's running about 6%. So my conclusion on the US is that inflation has peaked in the US, and it peaked at a single-digit level, and it's probably running about 6% at the moment.
Okay, so down from running at, say, just under 10, sort of mid-year.
Well, there was an observation of 9.1. Yeah. I think it was in the 12 months to June. But the important thing is, I think the US inflation has come down. Now, our inflation hasn't come down yet, but we're also disadvantaged by still relying mainly on quarterly CPI. Monthly figures have recently been produced, but there's not enough of them to be really helpful. But my guess is that our inflation will be similar to the US inflation, but with a lag.
Right. So we'll possibly have a bit further to run and then begin to fall off.
Yeah.
going back to that sort of discussion we had 6 months ago, and we talked about the full spectrum of possible outcomes, including the sort of not pleasant prospect of a sort of 1970s, 80s stagflation type environment. Given what you're seeing now with inflation and what that means, what you're thinking, are you taking that off the table as a tail risk?
Yeah, look, I think there was never a particularly high probability of that happening, but I think some people had a little doubt at the back of their mind, particularly those who'd lived through the 70s and 80s and worked through the 70s and 80s.
And paid mortgages through those periods.
Yeah, I think we can take it off the table now. I think that's one of the examples of improved certainty. I mean, I think we can eliminate that possibility. You couldn't have eliminated it 6 months ago, but I think you can eliminate it now.
And for investment markets, and that's one big significant comfort in terms of the downside risks, that's a much less possible outcome.
But, yeah, and you can see that in the bond yields. Bond yields jumped, as they should, but they've really flattened out now because they've sort of taken that off the table.
Yeah.
I don't know where they're going to end up, but I mean, bond yields in Australia, we had 16% 10-year bond in 1982. Things like that, no one's even contemplating that anymore.
16% return. Lots of people I think would be pretty eager for that, but maybe perhaps not the inflationary environment that would go with it.
That's right. Yeah.
So you're sharing a slightly more positive picture in terms of the inflation outlook. Let's step across now to what that might mean for monetary policy, and we've seen those significant rises, more so in the States than here. Where to from here as we sit mid-November?
Well, I think for the US, the Fed funds rate's 4%. I think for the US, the terminal rate is in sight. I think we've passed the phase where you were starting from a level that was so out of touch with reality that you had to have big increases each meeting. And I think we're now into a phase...
That was basically the payback for starting so late.
No, it's the payback for starting from zero. I think.
As well. Right.
Yeah. I think we never started from zero before. This is the first time we've started from zero. That's what makes this period unusual.
Particularly tough.
Yeah. So I think I could even conceive of the US terminal rate being 5. It's possible it won't need to go any higher than 5 if inflation continues to go down. And so that is more comforting.
And do you think they more slowly get to 5 from here, or do they keep going at a reasonably...
No, I think they would go at... well, they've been going in bigger increments than we have. We were going at 0.5. They're going at 0.75. Yeah.
Albeit a slightly more irregular sort of
they have less meetings.
Cycle.
We have 11 meetings a year. They have 8. So I think definitely. I think they would notch it down to 0.5, and then probably soon get back to the issue of 0.25 or less. I mean, 0.25 was the convention really for until this this part of the upcycle. It was the convention. The US only moved in 0.25 movements for a long time, and so they'll get back to that, I think, soon. So I think, I think there's a sort of the disaster scenario for inflation we can eliminate, and I think the sort of, if you want to call it, disaster scenario for interest rates we can eliminate.
Having to go to
We're
the
getting
extremes.
closer to sort of narrowing down a range of where things will probably end up. Well, not where they'll end up, where this phase will end up. What we don't know is how far down inflation will have come by the time we get over the hump. How far will it come down?
Yeah.
And
you've mentioned this phase a couple of times. So what if that inflation doesn't come down as much as...
Well, that's the thing we've got to worry about. It's not going to come down to 2. I just can't see it coming down within the next year or 18 months to 2. It's going to come down to something like 3 or 4. Interest rate, we're talking the US now, interest rate, just say the interest rates are 5, it comes down to 4, inflation comes down to 4.
How comfortable are the Fed with that?
Well, it actually depends on how effective the rise in interest rates is in slowing down the economy. Because to get inflation down, you actually have to slow down the economy quite a lot.
You've got to pull demand out of the system.
And so we're actually in a situation now, I think, in the US and in Australia, where you should actually almost be cheering evidence that the economy is slowing down. Because that's telling you that the adjustment is working with a lower level of interest rates than it might in an alternative scenario.
We've seen some evidence of that in the US and some of the economic data that comes out where there's negative economic data that the market has a better night in sort of reaction, that it hopes that the Fed won't need to go as aggressively because there's some bad news coming.
Yeah. Well, and that's logical, actually. I think that's logical for the market to think that way.
So it's like 10 years ago where the market used to celebrate those bad news because it meant more quantitative easing and more money printing. Now it means less interest rate rises, at least.
Yeah. So I think everywhere we should be, instead of praying for continued strong economy, which you normally do, you should be saying, no, we want to see that monetary policy had an effect, and it's definitely slowing down, and it's taking the pressure off particular sectors, particularly the labour market. I mean, the labour market always lags a bit, but the labour market is still so tight in the US and in Australia. It's extremely tight. It surprised me how it's held up. Well, the unemployment rate is held down, and our employment each month is quite strong. So in some ways it's the lags are longer, I think, than the normal. But we should be looking...
and is that possibly because we've come through such an unusual period of so low interest rates, people haven't quite... Some employers haven't fully grasped the...
I don't know. The labour market, I don't know. I think it means that, well, when we get to look ahead, I think some aspects of the adjustment should have been more severe and more powerful than early cycles. But to date, it hasn't happened. To date, the economy has held up remarkably well.
Before we step across to that and start to look at, I guess, risks of inflation and other things, I might ask, you talked terminal rate for the States, a corresponding view for Australia? So we've adjusted back to the 25 basis point
increases. If things go well, 4.
In terms of inflation coming off.
If the economy weakens over the next 12 months and inflation comes down, certainly Australia still has to go up, but it could well be a terminal rate. When I say terminal for in the next 18 months, it could be. I've quoted that before. It's a guess. I mean, there's nowhere near as much science to this as people think. Some of the academics have their models, and they think the central banks have got a model somewhere in the back room and they turn a handle. It's not like that at all. And the central banks, once they get somewhere near they think it should be. I mean, we knew 0 was too low.
Yeah.
You had to move
aggressively from there.
From 0. But once you get somewhere near where you think it should be, which is actually where you should be all the time, it's very close to where you think it should be, you make small movements and you're feeling your way, you're looking at the data, and that's where we're heading towards. 2022 will go down as an unusual year where central banks around the world all had to do the same thing in big quantities. Sharp, very strong easing, or a big lift in interest rates everywhere at the same time. Most unusual.
And I guess then to your point, if you're saying US terminal levels about 5, Australia maybe about 4, we're at least beginning in the territory of getting within 1% of those sorts of levels now. So potentially the moves from here can be more gradual rather than having to go certainly in 50 basis points.
Yeah, that's why I think the mood is better now than it was 6 months ago when we last spoke. That's why I'm a bit more confident now than I was 6 months ago when we last spoke.
So what is your views then in terms of, you talk about, I guess, an element of surprise at how well the rate increases to date have been absorbed, but it has been a lot in a short period of time, and the full effects are still playing out. Do you have a view on the recession question?
Well,
and probably more significant than that is obviously how deep a recession might be versus rather than.
Well, I'm not saying recession or not recession because it's a totally arbitrary concept. Yeah. This idea of 2 quarterly falls in a row, I don't know who invented that, but it's got no science behind it at all.
That's why the US have got a committee to
the US does it properly. They do it properly. They do it better than we do. The economy has to slow down. It has to slow down. You can't get inflation down unless the economy slows down. You can't get inflation down when the labour market is tight as we've got. Now, how's that going to happen? How does a tightening of monetary policy cause an economy to slow down? Well, there's a series of channels. I'll mention 2 that most people talk about, which I don't think will be very important this time. First one is business investment. Businesses find it more expensive to borrow, and there's not as many people offering them money. That sort of works, but very, very slowly. That's the slowest working channel.
Okay.
Business, and the other one is through the exchange rate. If you tighten monetary policy, usually it causes your exchange rate to go up. But if everyone is also tightening monetary policy at the same time, that one doesn't work. I think in Australia what we're going to see is the centrepiece of monetary policy affecting the economy will be through the housing market.
Right.
Through mortgages, through house prices, through house building.
I do recall one very significant line from the last time we spoke on this podcast, and that was the liquidity in the system in the United States ends up on Wall Street. In Australia, it ends up in house prices.
Exactly, and that's what it did. Huge increase in the number of mortgages, huge increase in the size of mortgages, huge increase in house prices. That's what we had. And that will go into reverse.
Right.
The first effect is that anyone who has a mortgage obviously is going to have to pay more for mortgage servicing, which means there'll be less income left over for spending on the other
surplus
things.
Cash flow.
Yeah, on other things. Now, some people, including me, have said that a third of the population, a third of households own the house outright, a third have a mortgage, and a third rent. That's not correct. That's what you get from looking at the census. But the census didn't ask the crucial question. The census left out all those investment mortgages.
Right.
They weren't interested in that subject.
Yeah.
If you put the 2.2 million people who have got an investment mortgage onto the ones who have got an occupied mortgage, it's a huge amount. You discover about 45%, possibly 50% of households have got a mortgage, including many who have a mortgage on their own house and a mortgage on an investment property. So a lot of people are going to get squeezed that way. And that is, in some sense, the main channel in Australia, and to some extent elsewhere, that monetary policy affects spending and demand in the economy. Now, that's not the only channel where housing comes into account. The next channel, of course, is house prices. House prices have been falling. They have
modestly so far.
They have to fall further. They have to fall further.
Considering the spike we've seen in that post-COVID March 2020 period, there's another significant leg up in property prices.
Yeah. Just think about it. The size of a mortgage that the average person on any income level can get is heavily influenced by the mortgage interest rate. If the mortgage interest rate goes up, you can only get a smaller mortgage. That's the only way you can maintain your mortgage service costs at the level of income that is agreed. So if mortgage interest rates are higher, the size of the mortgage has to be lower, and quite a lot lower, because what we're looking at, even already, if you put 3 percentage points onto the mortgage interest rate from its original low point,
Yeah.
you're virtually doubling it.
Mm.
So that has a very big impact on how the size of the new mortgages that are being created. So what that means is people who turn up at an auction to bid for a house have got a lot less firepower than they had before. They just can't afford the old prices. So prices have to come down to some extent to reflect the lower size of the mortgages that have been granted now. And so that's why a lot of people are forecasting very big falls in house prices. Like 15% is not uncommon. House prices have fallen in Australia on various occasions in my lifetime. 15% I think is a bit bigger than the previous falls, and 20 would be a lot bigger. Now, what does that do? What does falling house prices do?
Another dent in consumer confidence for a start.
Well, that's right. There's a sort of a wealth effect. People feel less wealthy. A lot of people talk about negative equity. If you've recently bought a house and the house price falls, it might fall below the size of your mortgage. I don't know how it's not very common, but it could happen. But I don't think that has a particularly big impact in Australia. I think people just put up with it. As long as they can continue to service their mortgage, they just tighten their belt. So I don't think that's the crucial channel.
And I guess that ultimately comes down to, do these probably still have a job?
Yes,
and if people
exactly.
still have a job and can find a way of paying their mortgage, traditionally, historically, people will pay their mortgage if nothing else. They'll keep going, even if they slip a bit into arrears, they work their way through.
That's right.
So,
and the banks will help them. The banks don't like foreclosing.
Fire sealing.
They hate that, yeah. But the other big channel whereby house prices have a huge influence is on home building. I mean, the building industry doesn't want to build houses if the prices are falling.
Particularly given the cost of construction in recent times.
Exactly. So that's the second big channel, I think. The first big
It's
channel,
a huge employer through the economy and ancillary services.
The first big channel was through the decline in consumption, as people have to pay more for their mortgages. And the second big channel is the building industry itself, which is not a huge part of GDP, but it sometimes can change by very big amounts, like plus 20% or minus 20% in a year. So I think we will see a big slowdown in the economy certainly by the second half of next year. And by then we should also be seeing the inflation rate coming down, and which it'll be a game of wait and see between the central banks and inflation. And then we don't really know in the long run. We don't know. We could end up in a stalemate where inflation just doesn't come down enough.
Stuck at 4.
The problem is if it comes down to 4, and you knew it was going to stay at 4 and never go above 4, you could probably live with it. The problem is once inflation is big enough for people to worry about it, think about it, and it influences their decisions in pricing and in wage setting, it tends to creep up. That's why we all around the world settled on inflation targets that had 2 in it somewhere rather than 4.
And I guess then that ultimately will lead through to what it means for interest rates, and then how hard we have to slow the economy to try and bring it down that last leg.
Well, we don't know. That'll be a totally new phase. I mean, that's the first phase was getting them up, getting interest rates up, and getting inflation rate to come down. And that phase, we're halfway through it. By the end of the next year, we'll have finished that phase. But we don't know really where we end up. Where we end up, we'll start another phase. I mean, it's conceivable that public opinion is so upset about the decline in activity that we just end up accommodating higher inflation. That is conceivable. On the other hand, it's conceivable that, particularly the way the US Fed is acting, that they're just not going to accept that at all. So we don't know what's going to happen.
They're certainly talking a strong game and following it up with significant rises.
Yeah.
Well, one of the speculative elements was that there wouldn't be the political will to try and put this through, and that at the first sign of trouble, that the stimulus cannons might come out again for another tour of duty. And to a degree, they tried that in the UK. So in sort of one of the unfortunate political cycles there, when they went through a few prime ministers in about 8 weeks, the mini budget was through. It had, I guess, it was uncosted, but there was significant stimulus that was going to be thrown at the economy. And interestingly, very significantly, the bond market just said, no, we're not having this.
Yeah, well, see, that is a possibility. That was something I used to worry about, because this is what happened in the US in 2019. They tried to get things back to normal, and then this event occurred in the Treasury market. That's meant to be the safest and deepest market in the world. And yet people were dumping their treasuries because they were so desperate for cash that the Fed had to come in. You have to in those circumstances. You couldn't stay
to
out.
Stabilise the market.
You have to. And then we saw a repeat now then in the UK, in a market that,
the gilts.
It was the gilts, but it was the defined benefit pension market, which was where the pressure built up. Same thing. Margin calls, got to get cash. What do we sell? We sell the thing that's easiest to sell, which is treasuries, or gilts as they call them. And so there's a panic in the gilts market. The Bank of England had to step in.
You made one comment in a recent investment committee meeting that stuck with me in relation to that, was sometimes the Treasury, the central banks, don't actually know where the pressure points, the pain points, or the risks in the chain are in the system until you begin to turn, and then suddenly one appears that you might not have foreseen. And that's what happened, as you describe, in that UK pension space once they had so much debt against those positions, and suddenly a pressure point emerged and exploded in a matter of days.
In both of those occasions, that was the case. In the US in 2019, it was in the repo market, which was heavily influenced by activity of hedge funds. And the Fed had no idea that was going to happen. But you know what's happening, because you're looking at the market every day, every minute of every day. And in the Fed's case, in the US case, what we call Treasury notes, short-term government paper, went up from sort of 1% to 9% in the space of a day. So you know what's happening. And in the UK case, it was the defined benefit pension industry, again, affecting the Treasury market. So I was always worried that these things were going to happen, and I always knew it would be in a part of the market that took you by surprise. You couldn't forecast it. It would take you by surprise. So I suppose we should be...
It probably reinforces your first point that you made, which is, considering where interest rates were and where we've gotten to, you might have expected many more pressure points or incidents like that than we've actually had, at least so far.
No, you're right. I agree. I would have thought there'd be more. So that's another reason why I'm slightly more comfortable than I was 6 months ago. We've got through as far as we have. And in this part of the cycle, I've only had one event, and that was in the UK, and it was triggered by a totally irresponsible piece of fiscal policy which frightened everyone. And the trigger for it, of course, is bond yields jumping. So crazy bit of fiscal policy, which would imply a big increase in the number of bonds that would have to be issued. So that causes bond yields to jump. Bond yields jump, put the pressure on this particular part of the market, the defined benefit pension funds. They have to sell things in a hurry to get cash. That puts pressure back down on the short-term end of the Treasury market. The central bank has to come in. No one else is going to buy it. That's the only one who can buy it, was the Bank of England. They're very dramatic, those events, and I thought there probably will be one or two as we go forward.
But thankfully not too many so far. And yourself as an investor sitting here today, how do you feel 6 months on in terms of...
Well, we're all waiting for, in terms of equity markets, we're all waiting for the economy to slow down, earnings to come down, and there to be another recognition of this in share prices.
So we've sort of seen PE multiples contract, but not yet the corporate profit downgrades that everybody's expecting, not anticipating, but expecting, hasn't really kicked in, which is, I guess, a risk to the downside from here. Albeit, if they don't come with the severity that the markets may be anticipating, then possible optimistic point.
The first shoe was dropped, which was caused by the recognition of higher interest rates affecting the present value of future earnings. The second shoe is going to be when the actual earnings go down. And I think funds managers around the world are all sitting there sort of waiting for this to happen so then they can pile in, which suggests that it's probably not going to be as big a fall as we earlier thought. If there's a lot of investors sitting on cash waiting for an opportunity, so the fall may not be as big as we earlier expected. But I'm not really haven't got a track record of forecasting share prices. That's not share prices.
I guess you're just enjoying the increased yields on your hybrids and your floating rate debt, and at least a return to normality on that front.
Well, yeah. Well, I wanted to say a little bit about this. I mean, why has the market accepted it? A very big increase in interest rates, 300 basis or US 400 basis point increase in interest rates. Why has it been accepted so calmly? And I've got several reasons why, I think. First of all, I think people already knew that the zero interest rate period was an anomaly. It wasn't natural. It had to end. Secondly, even though moving to, say, from 0 to 3 causes problems for a lot of people, once you're there, once you're at the new normal, well, people think, well, what's wrong with that? I mean, the economy ran in its most successful 20-year period, it ran with cash rate averaging 4 or 5%, mortgage rates a couple of percentage point higher. So what's so bad about that? I think, thirdly, as you said, there's a lot of people out there who actually depend on interest receipts, not just equity receipts, they return on interest. And for those people, their earnings have gone up. They've doubled. You mentioned hybrids. If you held a bank hybrid, your interest each quarter coming in is doubled. So you feel reasonably comfortable about that. And to date, dividends have held up quite well too. So it's been a nice period to have a portfolio, and your interest receipts have come up and so your dividends.
Albeit capital prices have moved around.
Yes, even though capital prices have gone down. And the final one that I thought, and this may be a little bit cheeky, but I think a lot of investors, particularly older investors, get a certain amount of enjoyment about seeing how the funny money people, speculators, have come a cropper, particularly the cryptocurrency people.
Dramatically so in the last couple of weeks.
Dramatically so. And also a lot of these very speculative startups which had billion-dollar valuations suddenly shrink to very low levels or disappear. And again, it's a part of the sort of return to normality.
Rationalisation.
Yeah, we didn't need this. This was part of the fake zero interest period. Yeah. And so we're coming back to reality.
Well, the reality is probably savers were penalised very heavily for a 10-year period now, and it's returned to normal economics of money. Capital has a cost, and a return risk should have an appropriate return, and everything should normalise. It's just an interesting year, 2022, and I look forward to sitting down again in 6 months' time and seeing what comes next.
Yeah. Well, I look forward to it too. Yeah.
But greatly appreciate your insights, as always. Thank you very much, Ian, and thank you to all our listeners. Speak soon.